Hey everyone, welcome back to another episode of the Integrating Investor. I am Seth Levine of the Integrating Investor website. I am delighted to be rejoined again by Jim Brown as guest co-host. He is going to continue his series on money and banking, and that's a continuation of my series on money and banking. And we are just really getting into this topic, I think, pretty handily. It is a pretty meaty topic and kind of interesting. And, as Jim and I both think, not to put words in his mouth, but he said so on the last show, these are very important. It's a very important concept to understand from an investing perspective, because, I keep going back to the conceptual hierarchy, and, please feel free to just pipe up in the chat or in the comment section if you don't know what I mean. But, we build concepts from percepts and then higher level concepts from those concepts. So it's really important to get fundamental concepts correct. And unfortunately, or fortunately, depending on your perspective, money is a very important one from an investing perspective, because after all, both money investing as well as banking is really making money from money. So as always, please like and share this show if you find value from it. You could always just hit the button right now. This way you don't have to think about it later. I'll probably do so myself. And, if you don't like it, you could just unlike it later or thumbs down or whatever. You could check me out on Twitter, also on Instagram to a lesser extent. Also check out my website, integratinginvestor.com, and subscribe to monthly emails. The email list there, you'll get my articles sent into your inbox. I just sent one out earlier this week on China, which I think was, is a little bit topical and hopefully interesting. May do a show on that as well. And of course, please use that super chat function. We got Jim Brown here. This is a great opportunity to pick his brain. I get to just sit back and do nothing, and he'll answer all your questions. And as always, feel free to email me at info@integratinginvestor.com. That's info@integratinginvestor.com. If you have any show suggestions, guest suggestions, or really just want to say hi, always appreciate getting stuff. And now, of course, my favorite part of the show, which we go to the lovely disclaimer. Again, these are just personal opinions, should not be construed as investment advice or recommendations to buy or sell any security or investment product or service. Please do your own work before investing your own capital and all that fun stuff. For those of you just joining in right now, last week, we really, Jim really started to talk about his view on money. And he brought up this great point that money creation is not what we think it is. Money is such an archaic and just familiar concept, yet it's so unfamiliar in so many ways. So what Jim was noting was that banks create money virtually out of thin air, right? When they make a loan, they basically just credit your account with money that they don't really have. Rather, they're crediting it with promises to pay. And really, these are just ledger transfers, both within an individual bank, but also among various financial institutions. Now, it's very important that I note that I phrased it this way, and I phrased it this way purposefully. And I'm gonna maybe revisit this at the end of the series with Jim. But much like banks create money out of thin air when they make loans, they also do so when they buy other assets and bonds. And as Jim noted, and as I noted, knowing money helps you invest. And I think Jim will really get into this pretty concretely as he goes through his series. But knowing where money comes from is going to help you figure out where it's going. And knowing the various influences on bankers can be, as Jim said in his last episode, to quote, it can be strong ammo to invest. And probably the most obvious case in a negative perspective is, it can help you identified bubbles and other sort of pockets of capital accumulation and decumulation, if that's even a word. So without further ado, I'm going to kick the show back over to Jim Brown. He needs no introduction. If you need an introduction, I'd recommend checking out part 1 of this series, which I'll make sure I link to in the show notes here, which I have not done so yet, but definitely by the end of the show. So without further ado, Jim, thanks for joining us again on the Integrating Investor.
Thank you, Seth. And that was actually a great introduction. So thank you for that. And it was not rehearsed, I have to tell you. That was great.
Thank you.
So today I want to talk about a particular aspect of banks' ability to create money through lending. And that is the fact, sort of the theme is today, that banks' ability to create money is sometimes controlled by the government to achieve government's political objectives. Now, most listeners think that spending on government programs is financed solely by taxation or increasing debt. And that is the traditional way. And that is the visible way that government spends on quote, public projects. But there's another way, and that is when politicians and bureaucrats direct banks to create money in order to give it to the project that the politicians and bureaucrats, want to support. And further, they make that credit creation profitable for the banks to do so. So that's very important, as we'll see in a minute. So the reason, just to reiterate Seth's point, that the reason that this is important for you to know is that if you didn't know that banks create money by making loans and buying bonds, purchasing assets and so on, you would not understand how government can manipulate the banking system to control economic development, investment, capital formation. They can really deeply and structurally influence the economy through the banking system. And we'll get into some few historical examples of that to drive that home.
Yeah, and that's a great point, Jim. Like, banking and finance is probably one of the most heavily regulated industries out there, right? And behind maybe healthcare, or I guess electric utilities for that matter, but it's definitely in the top 5 industry. And when we think about kind of those influences, those are real influences, on business people's behavior, right? So right. I think this is a great topic.
So to understand the effects of government intrusion or influence in the banking system, you have to contrast it to what I would call the normal circumstances of bank lending. So under normal circumstances, as I call it, banks lend, and their primary regulator is the discipline of the marketplace. I mean, even in our system of pure credit creation, banks have to make a profit to survive.
Hey, Jim, I got to interrupt here because that is such a crucial point, and something that I've heard too from one of my friends and mentors, and just really someone who I admire, John Tamney. He uses that word too, like the market is the regulator, and I think that's something that catches most people by surprise, because we don't think about market as regulator, right? We think we need an external regulator, but exactly to your point, you're going here is the market, the profit motives, and the incentive schemes of a free market really act to regulate behavior. So I didn't mean to interrupt, but I just want to highlight that for everyone, because
so banks are like any business that needs to make a profit to survive in a real market, in a free market. And what that means concretely is that the bank or the borrower has to take the bank's lending proceeds and invest those proceeds so that there's enough revenue to pay back the interest and principal on the loans. And that is not true of every borrower. And that means the banks have to choose their borrowers, the people they do business with, very carefully. So that is very critical to keep in mind, that there is an automatic, therefore, limit on how much money banks can create, because there's a limit on how much they can lend. And that is limited by the profitable opportunities out there among their customers in the market. And that is, in my opinion, quite sufficient to regulate the banks in and of itself. But the point is, banks have to remain profitable, because the possibility of bankruptcy prevents them from making too many bad loans. Their loans have to be profitable in the aggregate. Okay. Second point is, as Seth just mentioned, banks are already highly regulated. And not only that, under our system today, they are able to create money due to a legal privilege bestowed by the market. Now, I hasten to add, this is very different from a free banking gold standard. I'm talking about how things actually exist today. But in our system today, banks operate due to a government granted privilege, and they're able to create money due to a government granted privilege. So unfortunately, the same government that grants the privilege feels it has the right to modify the privilege or take the privilege away, or some way adjust that privilege. Okay, so the lesson, just one quick thing. I think the lesson for today is that governments can direct banks to lend, that is to create money, and the governments can tell the banks who gets the money, how much money they get, and under what conditions they get that money. And this is what I'm referring to for the rest of this chat today as directed credit. Directed credit. Now, I use a directed credit in a broad sense. It could be credit that's given by government command, or it could be credit that is given by government influence, nuance, nudging. By directed credit, I'm talking about any credit creation, any lending operation, for bond buying for that matter, but today I'm going to focus on lending. Any credit creation that did not flow from a free market, but depends on some policy or government policy or decree for success. So now this is a great time, I think, to take a break, and your comments are welcome, Seth, because when we get done with the break, I want to go into some examples of how this has happened in the past.
Yeah, that'd be great. Maybe just checking over in the chat. We have some super chat contributors, and thank you so much. Like, thank you, Jonathan, as always, for the $4.95. It'd be really great if we could just get the extra cent out of you to just round it up to a cool even $5. But I appreciate it. You've always been a huge supporter. MA, great to see you again. Appreciate all the stickers. Great seeing you on the boot camp yesterday as well.
I know who MA is.
Yeah, MA is it's my nickname for her. But yeah, okay. They've been huge supporters of the show. Really appreciate it. There's so many different angles kind of to jump off here, but I think I'd love to know if you can kind of share kind of some examples of how government kind of directs lending, kind of what the consequences of those are, and maybe the mechanisms that they used to do so.
Okay, there are various mechanisms and varied consequences. Probably the best example, to me, the most poignant example, is how directed lending created the Japanese asset bubble that culminated in the bubble bursting in 1989. Actually, this was a result of command lending. The Bank of Japan commanded all the Japanese banks, all its minions, for 2 decades, through the 70s and through the 80s, to lend to real estate enterprises. And they came up with quotas every year. And every year, the quotas required that you lend this much more to real estate enterprises. Of course, this created demand for real estate, buildings, and land developments and so forth. And of course, that demand increased the price. And then the prices that year were used as collateral for lending the next year. And because the of Japan never let up on this year after year after year, and they kept blowing the bubble up, and the market got quite complacent. The result was, this will astonish some people who are not a student of this crisis, but by 1989, and I was a fairly new stockbroker in the late 80s, and I heard the statistic and couldn't believe it. The Emperor's Palace in Japan was valued at that time more on a dollar basis than the entire state of California.
Wow.
And yet the bubble went on running for a few more years until it burst. I mean, that is perhaps, this is all, there's a great documentary called Princes of the Yen, Princes of the Yen. It's also a book written by Richard Werner, but it's on, you can find it if you Google it. But it documents how the main players in the Japanese financial hierarchy, mostly the Bank of Japan, but also the Ministry of Finance, directed this lending and caused this bubble. And by the way, that book became a bestseller in Japan, sold hundreds of thousands of copies.
Yeah, that is available on YouTube. I have watched that within the past maybe 2 years or so. It's pretty interesting, very fascinating. So
yeah, so it's a historical anomaly. Everyone's forgotten it. You know, it's many decades since over 25 years since that was over, but it left quite a scar on the Japanese economy.
Yeah, he who forgets is doomed to repeat, something like that, right?
Exactly. And now, since we're talking about little aphorisms like that, I'll say our history doesn't repeat, but it rhymes. So the way it rhymes, another great example, and this is a different kind of influence and a slightly different kind of result. The great financial crash of 2008. So some marked the beginning of this in 1995, some 1998, but basically banks lent way too much into the mortgage market. And the reason they kept lending to the mortgage market was that, for example, I maintain, because the government was involved. You had quasi-government entities, Fannie Mae and Freddie Mac, provided guarantees and support for the mortgage market. So banks were only too willing to make those loans and then load them off onto Fannie Mae and Freddie Mac. And there was also other things like government legislation, like the Community Reinvestment Act, that encouraged bad loans that would never have made it otherwise in the marketplace. So if you want a really good synopsis of this, a good record of this, John Allison wrote a really fine book, the Financial Crisis. It's called the Financial Crisis and the Free Market Cure. It's quite a good book. In my opinion, it's the best book on the crash that was written.
Yeah.
So
that's interesting.
That's another great example, and we're still suffering the fallout from that.
Yeah, and that's a big one. First, just to make sure our listeners got that we're talking about 2005 to 2008. Jim, I think you misspoke and said 1990, 95 and 98.
Oh, okay. Yeah. I was just saying the policy.
Oh, we lost you there, Jim.
Can you hear me?
Yeah, there you go.
Okay, I was just saying that the policies that led up to the crash started in the mid 90s to late 90s.
Oh, I gotcha.
So I misspoke there. Thank you.
Yeah, no, 100%.
No, the big blow up was all through the early 2000s. Yeah.
Yeah, and I've actually spoke about the great financial crisis in a couple places because I had a pretty unique seat for that. But I even see the sort of directed lending as even bigger as sort of the housing part just being one part of it. All the capital requirement rules, the favored positioning of the rating agencies in the role that they played in those ratings. There really was a huge demand. They created like this artificial demand pull from the financial system that wanted those loans that were then backed by the government. And it was just really, really messy, and I think artificially created kind of system. So
Yeah,
it's a
I
fascinating
think
one.
that's right. And I would just say, to the point of the title of your podcast here, the integrating point was government was at the bottom of all the excesses,
Yeah.
the excess in lending. So here's another great example. If you got kids in college, and that's government guaranteed student loans. There's no question that banks make a lot of those, not all of those. Some of those are direct government loans from direct government money, but banks make a lot of those loans. They are guaranteed by some government agency somewhere. And there's several forms of these guarantees. And there's no doubt that, easily, banks would never make loans normally to penniless students. They're very bad risk. But banks will make those loans if they're profitable, and they don't care whether they're profitable, because the market makes them profitable or government makes them profitable. So banks make these loans. This creates, as you just pointed out, artificial demand for to pay tuition, and the whole daisy chain happens. Colleges get more money. They put the money in things that raise the cost structure, and as a result, the cost of college goes up year after year at 10%, whereas consumer price inflation is 2 or 3%. And you see the difference. I put kids through college in 2000 and kids through college in 2020, and there's a huge difference, believe me.
Yeah, my kids are high single digits in age, and I am just terrified at what the cost of college is, maybe if we stay on this trajectory.
No, your kids are fortunate because they have a high earning podcaster to get them through college. So, congratulations to you.
Thank you. Thanks.
Okay, so another example is and I won't go into too much detail, but most recently the stimulus programs during the pandemic. Now, a lot of this was direct government payments, from budget money, but a significant portion of it was guaranteed loans. You've heard of the PPP loans, what was that called? The Paycheck Protection Program, I think. And there was all kinds of Main Street lending programs. None other than the Ayn Rand Institute took advantage of some of these, because there were even loans for nonprofits. This was free money in that it was bank loans that were guaranteed by the government, and most of those loans were then forgiven. And of course, the banks got paid by the government. So, this is an example of very similar programs in the UK as well. And yeah.
Interesting. So, so it seems like, the government is basically incentivizing, some kind of mix of incentivization and coercion, exerting those onto banks to make certain kind of loans. Right. And now these loans may not essentially be, essentially they're artificial in a sense, whereas they wouldn't stand on their own in a free market, at least in their form. I mean, how does the government kind of ensure that the banks, are profitable and they could stay in business? Is there some kind of loan guarantee? Like why do the banks why do the banks like it? And how do they make sure that they don't, really, it doesn't threaten their business?
Banks like it very simply because they can't lose. The banks like it because this is a loan that is going to succeed. And the government likes it because if I can, and I think that's real clear. The government likes it because it is for several reasons. And this is very important for us to understand, this audience. The government likes it, number one, because this is hard to see and hard to understand. It's a bit hidden. It's a way to get new money to the entity that you want without taxing anyone, without borrowing money, both of which would show up in the budget and both of which would be controversial. But when you just give a bank an incentive to lend,
or an order,
And that, as I say, it does run the spectrum. When you give them an order and incentive, the whole spectrum of these things to lend. This is not, there's really no line item on the federal budget. Have to understand that to make a bad loan succeed, you need only a small point of that. A loan, you would get this right away, Seth. If 10% of loans are bad, a bank goes out of business like immediately. If one loan gets only 90% of it paid back, the capital behind that loan is wiped out. So a loan has to pay back in full because banks operate on pretty thin margins. Otherwise, it's a loss. And if you have too many of those, the bank goes out of business. But if the government can change the capital rules of the bank, and they do this sometimes, or if the government can say, well, I'll guarantee 10% of this loan, the bank is covered. They can make 100% loan. They can own 90% of the proceeds, and their payback is completely taken care of. And this is the kind of thing that was done during the crisis. And there wasn't huge take up on this loan. It didn't amount to much, but the precedent was definitely set. So I expect to see more of this in the future. I want to stress again, when the government does this, the only line item on the budget is a little footnote, a little contingent liability. That's it. No one notices. So it's a pretty crafty way to get away with it. And if you would, if you would put up, Seth, for just a minute, those graphs that I sent that come from the Fed.
Sure thing. Let me.
If you show first the total money supply.
You got it. Hang on. Bear with me, everyone.
Okay, just keep doing that, and I'll keep going.
There we go.
Okay, so this is total money supply, also known as M2, and it sits right now at $21 trillion. And you can see what happened during. It's a little hard to see there, but right at the beginning of 2000 is when it takes a huge jump up. It's like about a $3 trillion jump up.
This is 2020.
What did I say?
Yeah,
2000.
Yeah. Like during the COVID stimulus. Yeah.
Yep, because this is a 5-year chart. And now, if you would show deposits, bank deposits,
Got it.
it's going to be a very similar looking chart.
Here we go.
Did you notice any difference?
Yeah, they look almost the same. I could toggle back and forth for everyone. Yeah.
Yeah. So total M2 is total money supply is about 21 trillion. Total bank deposits today are about 17.5 trillion. And most of the rest is in currency, currency that's not outside the banking system, that's been withdrawn from the bank.
There you go. Yes. So this is a picture of currency. So I think maybe
the main point of that sequence was to show you that most of the increase in the money supply is accounted for by an increase in bank deposits. And that's a lot of that, not all, but a lot of that is increased loans. And a lot of that is guaranteed loans, because who would lend in the middle of a nasty pandemic if it were not a government guarantee?
Or maybe said differently, who would loan at such low rates without that? And a lot of people may not even know this. Like, there are laws that dictate how much money you can actually, the interest rate that you could actually charge on loans.
Oh, usury laws, yeah.
They are usury laws. So, there's not to say, like, nobody would actually know. Like, we don't have the free market pricing mechanism in place to even know if loans would occur. That's just because there's essentially a ceiling placed on on the price, and that obviously the laws of supply and demand impact that.
That's a great point, which gives rise to a shadow banking industry, which shouldn't
that's a whole
shouldn't probably have to exist. So
shouldn't have to
Seth,
exist at all. Yeah.
I noticed our time. Do we have time for me to make one kind of a money point here, kind of a payoff
Yeah.
point for the audience?
Yeah,
So, I mean,
absolutely.
so, I mean,
There
yeah,
is
go
something
ahead.
I just would like to note. So just for those not as sort of steeped in the monetary and wonky world, the first chart of M2, the total money supply inclusive in that are all the other charts that followed. It's sort of a breakdown. So what the chart is really showing is that how the big jump in the broad money supply is really being accounted for changes in bank deposits, or that is really where the bulk of it occurred. So just to clear that up in case anyone isn't as just in case there was any confusion out there. So sure, yeah, that's it. Go ahead, Jim.
Yeah. Okay. So, why should you care about this stuff in the past and things you didn't have any control of? Well, I'm going to get a little bit speculative here, but only a little bit. I think that we are going to see a sort of resurgence, sort of an evil renaissance, if you will, of directed lending, government influencing bank lending and bank operations for the purpose of creating money, for the purpose of getting it to specific industries. And where I think that's going to go is into the green energy industry and all the associated industries. Obviously, I think I can say this to this audience. We have a strange mania about climate change sweeping the world. I mean, 90% of the world seems to be, can't be this high, but it seems that 90% of the world believes we are in imminent danger of disaster from carbon dioxide and other greenhouse gases, and that we must reorient industry catastrophically in order to counter this, and that the only way this is done is if the directions come from on high. So on this line, I had a very interesting conference call about 2 weeks ago with an old colleague of mine who lives in the UK, probably have a lot of visitors from the UK today, viewers from the UK. This is Stuart Graham from Autonomous Partners. And Stuart is projecting that the European banks, European bankers who lend all over the world, but mostly in Europe and Asia, have an appetite to lend somewhere between 1.3 and 3.2 trillion dollars per year for the next 30 years for green energy. We're talking about maybe $50 trillion of lending. That's new money, new credit creation that will go to green energy projects, which means windmills, solar panels, and associated infrastructure. Now, I mean, that just about blew me away. That is a huge amount of money. And what he said was that not only is the government providing incentives the government providing incentives and guarantees, but the bankers are all in for this because they're so convinced of this ideology. They welcome it. So maybe this is a new twist on credit. Maybe we're getting an ideological form of credit creation that we maybe not have seen to this extent before. But I think it's important for us to realize that this may be coming. And it may be, if it's coming to Europe, it's likely coming to the USA. Now that opens your mind to what other kind of possible, credit creation gambits could there be? Could you see reparation loans? Loans that favor certain ethnic groups or people of certain heritage, and maybe nothing available for other people. So at the same time you see certain groups and political interests favored, you will see other groups and political interests disfavored. So I'll bet you will see, if you haven't already seen it, brown energy products, energy projects like traditional oil and gas, that's not going to come from banks. That's going to come less and less from banks. That'll be seen as breaching some kind of fiduciary responsibility if you lend to such an irresponsible entity. So expect more direction by government of credit toward what is popular in the psyche of today and what is most popular, with the parties in power. Now, I hasten to add,
and that's really interesting, Jim, too. Just to kind of like tie it back to investing, those have very important investing implications. We should note, right? Because let's take the, kind of the brown energy, kind of the defunding of traditional fossil fuel industry, that if the funding for those industries go less traditional, for lack of a better word, those will probably garner higher rates of funding markets. And what that means is, you're going to have basically higher costs of capital for those industries, not to get too wonky, but that's going to mean that those companies are going to have either lower returns or have to raise prices. And those are really, those have important investment implications. And the converse goes to sort of, maybe pet projects, right? Maybe green projects or ESG related projects or anything else. The inflow of capital is going to have valuation and return return implications. So these are very, these are more than just political topics. I mean, they are political topics. I don't, the moral topics, but they are also investing topics as well. I don't mean to cut you off, Jim, but we do have some super chat activity that I'd be remiss if I ignore. MA, thank you again. So MA asks a while ago, my bad. Doesn't the government sometimes force banks to make bad loans and then blame the banks for the consequences? Jim, I'll kick that over to you. But and MA, I think that's most starkly what we saw in the in the 2008 great financial crisis, where a lot of the banks and the banks were, Wall Street was blamed for the great financial crisis, and I would say quite unfairly in a sense. And it's it's complicated. Were there bad actors on Wall Street? Absolutely, but it's really you have an industry that's playing with a really perverse set of rules. And that just creates all sorts of bad behavior by everyone involved. So it's hard to, it's kind of like don't hate the player, hate the game a little bit. MA also says that John Allison didn't want or take it. I assume she's talking about the bailout money. That's very true. True. And even, famously too, there were other banks as well. Most famously, probably JP Morgan didn't want to take TARP funds, but you know what? He was forced to. Right?
So was BB&T. John was too. He wrote a famous letter, to the Treasury, to Tim Geithner, saying, "I don't want it, don't need it. We're sound." But at the end of the day, it was basically the implicit threat was, "We're coming down on you on the regulatory side if you don't join the mob and take the money."
That's right. And that goes back to credit creation, right? Because those were funds that the government gave to banks. So if you go back, again, this is another way in which government could influences credit creation. I mean, the list is on and on. History is littered with it. Go back to the earliest central banks. I mean, the early central banks were co-opted and formed, by governments to fund themselves, and primarily for war, because we're talking about kind of the post-Renaissance period. So, Jim, we covered a lot of ground here. We talked a lot about how government government intervenes in the credit markets. I mean, we really just scratched the surface. It's really hard to go any more than scratching the surface. But this is probably a good time to stop. Jim, like where if you want to just remind people where they can follow you and keep up with your work.
I'm on Substack. It's hard money Jim, just like it sounds, and you can find me there on Substack. I guess I should have given you a website to look at, or you can find me Twitter, and that'll direct you there. It's at Hard Money Jim. And I'm Jim Brown, CFA on LinkedIn.
Excellent. And, with that, thank you everyone for your super chat donations. MA, thank you so much. I read John Allison's excellent books. Yes, John Allison is quite an intellect, in my opinion. Thank you, Jonathan, for your super chat. Everyone out there, thanks for watching as always. Next week, I'll be back with the show. Jim, I'm going to give Jim the week off for a change. So I'll come back with another episode of the Integrating Investor, but Jim is not done. Jim will be back. So we are going to...
if you'll have me.
Oh, I would love to have you. So everyone, hey, if you want Jim back, thumbs up this, give it a share. With that, have a great weekend, everyone. Happy Halloween to anyone celebrating in the U.S. And we'll see you next week. Take care, everyone.
Yep. See ya.